Stefan Hofer, emerging market economist with Bank of Julius Baer. He joins us live from Hong Kong. Stefan, good morning and thank you for joining us.
Good morning.
Suddenly everyone is convinced that risk-on trade here is here to stay. I think Janet Yellen has clearly alluded to the fact that U.S. economy has not recovered and they are likely to follow a loose monetary policy.
Yes, that's right. I think there's been, a number of things have taken place recently which have certainly boosted market sentiment both globally and I think more importantly also finally for China within an emerging market context. Exactly as you say, it's becoming more and more apparent to financial markets everywhere that a Janet Yellen-led Fed will be, in all likelihood, dovish for longer. Her background as a very accomplished labor economist does imply that there will be a greater focus on the path of the recovery of the U.S. labor market as opposed to issues regarding inflation. This means that in all likelihood we're just going to have more of the same, but certainly a dovish bias. That sort of puts us into a relative sweet spot in terms of risky assets because on one hand you have a global recovery or a U.S. recovery which is okay, but it's certainly below the previous trend. You have hardly any signs of inflation. At the same time, these sort of lingering clouds over the labor market. So these all combine actually quite nicely to give you a relatively supportive backdrop for risky assets. And this spills over quite nicely as well into emerging markets for 2014.
Stefan, what's the outlook on China now, given the recent third plenum session?
Yes, China, I mean, I think we have to look at it as a longer narrative that actually started at the end of September with the launch of the Shanghai Free Trade Zone. We had that, then we've had the plenum that just took place, and now sort of more discussions regarding the TPP, sort of into the longer term, and China's potential membership of that. I mean, 2013 in general has been a very difficult year for emerging markets, certainly also China and Chinese assets with the exception of the renminbi itself. Now I think markets are sort of really beginning to recognize that there are some important catalysts that have been unleashed recently. As I mentioned, these three things, the Shanghai Free Trade Zone, the plenum, and these ideas about a Chinese membership in the TPP. So what we've seen in the last sort of few weeks and certainly the last few days is more confidence from investors around the world to be taking on a Chinese exposure, which I think they've been relatively underweight for most of this year. In addition to that, there's also recognition that Chinese valuations, finally after such a long period of underperformance, are now also quite cheap, and we do have a rebound that is taking place on Chinese earnings. So you have enough things which are coming together, which I think are sort of encouraging investors once again to take on Chinese equity exposure in a broader context of having more emerging markets in their portfolios.
Stefan, historically we've seen that there is always the inverse correlation between developed market equities and emerging market equities. But currently, developed market equities and emerging market equities are moving in a synchronized manner. Last night, Dow crossed 16,000, and the news from Asia is that markets like India and China are sitting at a record high.
These relationships between, for example, mature market equities and emerging market equities, and also things like the direction of the U.S. Treasury yield and the performance of emerging market stocks. These relationships have been thrown a little bit into the wind in 2013. I think especially since May 22nd, when the tapering language was introduced from the Fed. Markets are sort of struggling to sort of follow the previous relationships as strongly as before because, in essence, we are in a very unprecedented territory when we think about this massive expansion of central bank balance sheets around the world. And now we're heading into the sunset of that, into the sort of the next phase, which is essentially the exit, with the exception of the Bank of Japan, who remains very accommodative. So these basic relationships are, I think, in essence, just not as strong as they used to be. So it's a little bit difficult to base an investment strategy based on those older rule of thumbs. I think, in essence, when we think about emerging market stocks for the rest of the year and the beginning of next year, 2013 was very awkward, was very, very challenging. A lot of underperformance for most of that period. And now, finally, with some positive catalysts, indeed, coming out of major markets like China, and also, I think, in fact, renewed optimism regarding India as well, things finally do look a little bit brighter for 2014.
What about the twin deficit front for India right now and the view on the currency over the next 6 to 12 months? Because in the near term, clearly these two factors seem to be playing spoilsport.
Yes, I mean, on the other hand, the twin deficits are well known by markets. These are certainly not new developments. I think in general, international investors are still very excited and very motivated by the new policies that have been unveiled by the new central bank governor, Mr. Rajan himself. And in terms of the currency, I mean, at least in terms of our own forecast, I mean, we do consider the Indian rupee to be actually quite undervalued still at current levels. Our valuation models point more to sort of a 55, 52 type level against the US dollar. So I think all else being equal, actually, we would look to be buying still at the current spot levels for the Indian rupee. Now, at the end of the day, we all know that it very much has to do with the election calendar that is coming up, which sort of complicates that trade somewhat. But I think really in a broader context, India, China, the major markets in Asia have really had a lot of headwinds this year, and those are finally, I think, are clearing out. Perhaps more shorter term, we do actually see more upside potential in North Asian markets like South Korea, which are very exposed to demand coming from the G3 markets in terms of import demand, so the United States, Europe, and Japan. We're seeing a remarkably strong rebound in Korean exports, and that has yet to filter through to their earnings. So I think maybe tactically shorter term, things do look somewhat more rosy for North Asian markets, in particular South Korea. But, I think we think about the really, really big ones in Asia, China, for example, and also including India, and that 2014 certainly a better year than the previous one or the current one.
Stefan, good chatting with you. Really appreciate you taking the time out and speaking with us.